Today, we are diving back into one of our favorite content pillars, not your average insights. As we know, the White House has released executive orders that are allowing investors to use their 401k for alternative investments. We're going to dive into some of that. Then we're going to talk about an article that talked about the median age of a buyer having a drastic increase as of late and what that means. And then we're gonna do a little football season.
It's football season.
Season topic. We're gonna talk about stadium deals, how they fit in, right? Like it is, these professional sports franchises are kind of like the ultimate rich guy investment, but it's really a real estate deal in most of these things, and not all real estate deals in professional sports are built the same. So GC's got some opinions.
Here we go.
Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow. He's a great co-host, and because his name is Gregg Cohen. Say hello.
Hello, everybody. Fantastic to be with you today.
It is good to be here with you, too, in studio, GC, as we are on football eve.
How about that?
Did you watch a little college football this week?
Oh my gosh, I watched so much college football this weekend. It was so good.
Yeah.
I filled my college football bucket, and I'm ready for that bucket to be filled every Saturday for the next however many months.
I'm excited. All right, GC, let's get into this topic today. From how I understand it, in my meager mind, the White House is looking to help people diversify from the traditional stock and bond portfolio, have access to alternative assets. I've heard they want people to have more upside, and they want folks to just have, democratize this access by allowing folks to invest with their 401k in things such as private equity, crypto, and real estate. Seems a pretty big deal. You think it's a big deal for real estate?
I think it is the beginning of potentially a very big deal.
Oh,
nice edge. Prior to this, part of the things that we do on this show is help people beyond the so-called restrictions that people think about creating wealth. And one of those restrictions is people have just assumed that the only things they can invest in their 401k in are stocks and bonds. And so this would potentially open up to a lot of different things beyond stocks and bonds. And I think even just changing that narrative to only stocks and bonds to something beyond it is an interesting conversation and something that could have a lot of positives, could have some cons as well.
Yeah, I like the idea. I like the language, democratization. I know that there's some stuff in there talking about kind of like giving people that are not just accredited investors access to these kinds of assets. I think that that's a really cool idea. I think the idea of opening up the aperture to put these other investment types like real estate on par with stocks and bonds, and like habitualizing people to see them as retirement vehicles, not just as hobbies or something that you do once you have this other stuff figured out kind of thing, right? Like I like that stuff. To me, the catch is that they are still making it something that has to be like a fun kind of thing, right? Like it doesn't feel like there's like direct access to this type of stuff. You're not going to just be able to log into your 401k and buy a rental property, for example, right? Like it feels to me that it is pushing it more towards the same, and I think it's necessary, right? To like kind of like start as not too far, but it's still kind of like a lot of what I read in it is focused in a way so that now a fund manager can also get some kind of like cut off of this thing going into a portfolio assets under management kind of model that they see. And I don't get the sense that, like, I feel like it's really tailored towards private equity and crypto because that's pretty easy to do there, less so tailored towards real estate. And if the goal here is to give people access to things with upside, you should also give them access to things to upside that have the best risk mitigation, which I think is real estate. What do you think about that? Is that too much?
Well, I'm trying to understand. Like, would you say that this is generally a good thing, but not an ideal thing, or is this a bad thing in your opinion?
I don't know if I'd go as far as to think that this is a bad thing. I would love for this to have led the way with real estate. If you think about the number one asset class that drives wealth in America,
Mm-hmm.
if you think about what I think is one of the safest things to hold over a long time,
Mm-hmm.
it's real estate.
Mm-hmm.
So, if I wanted to like change the system and open stuff up, I would change the system and engineered it towards the thing that has the most track record and the most history and the most success
Mm-hmm.
for the most folks.
Mm-hmm.
While it seems to me that the thing that it got opened up to is like crypto and private equity and kind of like a little bit of like same old stuff, but with more risk and more kind of like more wild card under the flag of diversity.
Yeah, I think those are getting the headlines of
Yeah.
it, but you know, the benefits of real estate that you're talking about,
Mhm.
while it can't be done through a buying turnkey owning single family rental properties, which gives you that control that you're talking about. You don't have to pay things like asset management fees. Like what we have is sort of special, and this is what we have cannot be tapped into what this executive order is. However, but real estate can be tapped into through the form of private equity and through some of these structures.
Okay.
So if you're searching for a better asset to invest in, now there's more risky real estate and there's quote unquote less risky real estate.
Yeah.
So if you're looking for something to do, let's just say it's you and you're looking for your 401k with what to do and you want to get into real estate and you have no clue that the Not Your Average Investor show exists and that you can actually buy turnkey rental properties in your retirement accounts. You could look at this and say, well, you know what? At least that individual now can invest their 401k in private equity where the underlying asset is real estate, which might be a positive and certainly is a positive if the goal is diversification and the goal is an asset class that historically is consistent and reliable. So you could make an argument for that.
I guess. So tell me more about like why when I first saw this, I was like, dude, this is great for JWB. Like I would assume that like somebody like JWB would be the type of company that would benefit the most. And you're like, I don't know if we're gonna really benefit from this. Can you explain kind of like, can you explain
Yeah.
that?
So, for JWB, we don't sell through a fund structure. So there has to be some sort of a fund in order potentially for this executive order to go through and wind up as an option for 401k plans. A million hurdles have to be overcome, but the end hurdle would be they are only going to offer assets or make it easy to offer assets that are in a fund structure. And the reality is that it's very inefficient to do it any other way. And if you're talking about opening this up to trillions of dollars of 401k plans, the fund model is really the only way that they're going to do this. Now, there could be funds of single family rental properties and things of that, so you could get close to it, but it's the fund model. Now, JWB, we have the opportunity to do a fund model, but we choose not to. And it's because it serves our clients better, because as in a fund model, it's actually, you give up a lot of control.
Yep.
You do have extra fees like asset management fees that clients don't need to have. And our model works really well. If you remember how we started our company, we were not selling to individuals that are what's called accredited in the very beginning of our company. So our company is built selling properties to individuals who may or may not be accredited. If you do a fund model, you only can market and advertise to accredited individuals. So our asset works so well for non-accredited individuals and accredited individuals.
Yep.
Plus, there's more fees that you would have to incur. The debt options are a lot less valuable for you if we were in a fund model, and then you don't have control. So JWB chooses not to sell our properties through a fund model, because that's the business that we've built. So I don't remember what the beginning question was, but somehow I got there.
How come like you guys aren't going to be able to partake in this? Like you
Yeah,
choose
there we
not
go.
to sell in a fund model. Did you guys choose not to sell in a fund model because it would make it too hard to overcome these hurdles, or did you choose not to sell in a fund model because you believe that this model is better for the consumer?
I've gotten very close over the years to trying to make a fund model work for us. I've done a ton of pro formas, and I've investigated every aspect of it. And the reason why we have not done that is because ultimately the risk-adjusted return on the investment for the client at the end is not nearly as good as the model that we have right now.
And this is my beef with it.
Okay.
Right?
Well,
like if we are opening up to help people diversify, right? Like if we are trying to do this, and by the way, Papa brings up the good point. He's asking like, do you think being done via executive order, as opposed to like bill from Congress, would have required more like details and discussions and concerns of safety? If you're going to do an executive order, you're going to be like, "Well, I just decree it to be this way," right? Like, then decree it to be the way that is most democratized for the most people, like that can really give them the best business model, that gives them the best risk-adjusted return on investment, as opposed to whatever is easiest for, like, I don't know, people to get a assets under management fee on.
I love where you're going. It's, just our, we are a turnkey operator. We'll sell, a few hundred homes this year, right?
Yeah.
There's like pretty much one of us in the country,
Yeah.
like
Yeah, but
if,
wouldn't there be more? Like, shouldn't there be more JWBs?
yeah, I see where you're coming from. I mean, we're a special breed, right? There's four guys who came together to build this.
Yeah.
And we built this business because we wanted to make a big impact. We wanted to make a big impact locally. We believed in culture. We believed in building this team. It's been 20 years of building this. Like, there's not a lot of people that build a business the way that we intended to build this business. It's much easier for them to just go and create a fund and then call a few of their rich friends, raise a few $1 million, and then start making asset management fees. So like, we took the slow and the steady approach, and we built it off the backs of what made us financially successful. And so it's a different road. So I guess, yes, I wish there was more access to this, but there's a whole lot of shortcuts that other people can take that are much more profitable to do it. So I don't think you're going to convince a whole lot of people to build what we built at JWB.
Yeah, that's fair. Like, I get it, right? Like, I think you get what you incentivize, though, right? Like, you guys are extraordinary because nobody incentivized you to build this outside of you finding a gap in the market that happens to fit, and it fits your personality and your long-term outlook, and because of that, you're so different. I think if we were to create roads for folks to build companies like these, that if you are able to come and perform and do these kinds of things, then then there would be more three friends that get together and don't create a fund, instead create this like vertically integrated experience that allows people to invest in workforce housings, which we desperately need in America, as opposed to just like putting up buildings and like syndicating it.
Yeah, I think we're looking at this and our threshold for what is kind of good in this sense
Yeah.
is just, we're just looking at it a little bit differently. So like, I think I'm looking at it more pragmatically,
Yeah.
and just saying, hey, listen, on the surface here, this is probably a positive step
Yeah.
for the average investor to be able to have access to things beyond stocks and bonds in their 401k. So I think we can probably agree that there's some positivity from that. Your point's really valid, which is this leading people to ultimately what we have found as being the best way to build wealth, which is to own a portfolio of single family rental properties and have
That
it
you
professionally
own,
managed that
yeah.
you own and control?
Yeah.
Probably not.
Yeah.
But is it better than what reality is today?
True.
For most investors who are
Sure.
highly, highly concentrated in one asset class, it's probably better than that today. So I think that's probably just the two lenses there.
Fair, and the other asset classes also deserve their day in the sun, right? Like, we should normalize these things. They've become
Yeah.
normalized. There's people should be able to like invest in what they want to invest in. At the end of the day, the 401k was created to give us control, right? Like, so like it is in the spirit of the 401k. So I'm not trying to poo-poo the overall spirit of it. I guess it just like I went from being super excited that this could now maybe lead to like JWB selling into 401ks because I have grown to love this model, to then be like, like,
Yeah.
all right, I guess it's just gonna like get more real estate talk going.
Honestly,
I'll take it.
even if somehow this executive order and all of the congressional actions and every department that would need to look at this, even if they said, hey, you know what, JWB, you can start selling your turnkey properties through 401ks, I don't know if it'd be best for our business model. Because one of the things that we spend a lot of time doing, it's the reason that we have a few conversations with folks before they buy properties with us, is we set expectations. Can you imagine if we were just on every 401k platform and everybody's like, boop, I'm just going to put 50 grand, 100 grand, 200 grand into this? I mean, it'd be great for sales. But when certain things happen, like, a cash flow, you have a maintenance cost. If we don't have those conversations ahead of time to set the right expectations, is that 401k investor going to be prepared for the ups and the downs of this investment?
Sure.
I mean, the answer would be no. So, I mean, Honestly, if we got on every platform for 401ks, I think we'd figure out a way to make sure that people were prepared effectively. It would probably be a good thing for JWB business, but it just goes to reinforce that like the relationship matters here on the turnkey side. When you invest with the right relationship, choose the right market, then the assets take care of themselves. But that happens to be our model. The 401k thing, I think the positives overall is that it opens up people's minds. I mean, we spent a lot of time here trying to help people see beyond just stocks and bonds, right? So if this, in bare minimum, just opens up people's minds that their 401k and their retirement account can be in other things,
True.
Now then they need to do the due diligence to make sure it's a good asset, but that it can be in other things. I think that's a win for all alternative assets.
That makes sense. That makes sense. So I concede, Greg, this is a good move. I wasn't trying to say that this isn't a good move. I guess I just got hot and bothered by the whole like.
I love your angle. I really do.
Yeah.
If you didn't take that angle, I probably would have taken that angle. So it's kind of
counted points. All right. Now we're going to discuss another article as we move along here. I just shared it in the chat, but essentially we just saw this data point in here that tells us, where is it? Boom. Article from Apollo.com that says the median age of home buyers right now is 56. It starts by saying that we were at 31 in 1981, median age of home buyers, not first-time home buyers.
Gotcha.
Median age of home buyers, 31 in the early 80s. In 2021, it was 45, and now we are at 56 is the median age of home buyers. What's the first thing that you think of when you hear this?
Affordability challenges, man. Affordability challenges and obstacles for everyday people to own an asset that has made more people financially secure and financially wealthy than any other asset with less obstacles. Now we have affordability, which is a major obstacle. So I feel bad for those who can't take part in this asset class because of affordability.
I mean, it's a concerning number, I think, right? Like to think that what is it? We call it the American dream, right? Home ownership, control of your own space and your destiny and stuff like that. The fact that the median age has gotten that much older tells me that young people are, whether capacity or mentality, like having a hard time talking themselves into buying their own home.
Yeah.
Right? Like maybe it's too expensive. Maybe they're just like, I don't know how I feel about America. Right? Like to me, it's a whole long tail thing. Like I know that when my wife and I finally bought our own place here in Jacksonville, as much as I loved Jacksonville, it created a sense of space and a sense of belonging that I did not know I was missing, right? And I for sure didn't realize how much she was missing it. And it's been such a game changer. So I'm sad when I see the number. When I think about it from the investor lens and from what we're doing here, it continues to reinforce the belief for me that investing in these like starter homes, workforce housing, supplying workforce housing, creating a very livable experience from people that care about you in workforce housing is not just, it's investing in a critical need, it's investing in the critical infrastructure of America. Like we need more money flowing this way. And I think the only thing that can help is increase supply, as you say, right?
Yep, 100%. I mean, I think, it's a critical need for the individual to be owning a home, just like you expressed your own personal situation. It's a critical need. Sometimes you don't even know you need it until you get to experience what being a homeowner really means and walking down the street of your neighborhood and looking at your neighbors and saying, hey, you know what? I planted my flag here. This is going to be my spot. You pick up trash a little bit more often down the street. You do whatever. You look out for your neighbor a little bit more. So it's a critical need for the individual. It's also a critical need for the community and for the neighborhood and for the market. And it's also a critical need for our government that especially first-time home buyers and ownership overall is strong. And that's why you see the government incentivize us to be able to own homes. They need home ownership to be working in our government, in our country. And that's part of the reason why we have loans that are available to us that you don't get in other countries. It's because our country has figured out that home ownership is so important. So it's a critical need at every step along the way. And you start to say, well, we know we have affordability challenges. I think people look at that and say, well, what are a couple of ways that you can solve affordability challenges? And people would probably look to interest rates. interest rates have been elevated for a very long time now. And if are to have lower interest rates, that immediately helps with affordability. But that doesn't solve the affordability problem, right? What we really need to solve the affordability problem is we need to increase supply. But it's not just any type of supply of housing. We need to increase the supply of housing that is missing the most, which is workforce housing. And so if you have an opportunity here's the way I look at what we do at JWB. If you have an opportunity to make a great investment, that's one thing, and earn a great risk-adjusted return, we love doing that. But if you have an opportunity to be a part of a bigger solution for a bigger problem, that's what gets me excited. And I don't know if everybody really understands how much of a part of the solution those who invest in turnkey rental properties, especially new construction turnkey rental properties, you're helping to solve the affordability problem because you are bringing more supply of houses, the houses that are needed most, new construction, into the neighborhoods that are needed most, workforce housing, which can help to ease affordability concerns as we look forward into the future.
Yeah, man. I think this is the moment where I think we're coming up on half an hour. We're trying not to be like salesy or whatever on the show. Half an hour in, we're doing the JWB commercial. And it just so happens that it ties up with exactly what you're saying, right? Like investing in workforce housing, bringing these things to market, right? Like serving the community with someone that's bringing these and then bringing owners of these properties like us in the Not Your Average Investor Show community. What you guys are doing to me is like one of these like few shining examples of trying to do everything possible to solve for this, right? So if anybody that is watching this for the first time, you don't know what JWB does, that's what they do. They bring in, they're completely vertically integrated turnkey rental property investing company. You guys, from everything from the land to the construction to the residents to like managing the communities to investing in the economic development of the city, you do it all and you make it very, very passive for a retail investor like myself to own properties when you don't have the time. And if you want to know more about that, go to jwbrealestatecapital.com/report, and you can download the Q2, Q3 quarterly market update that JWB does that tells you about Jacksonville. Anything you want to add to that before?
I think you did a great job.
So now that we're back to this discussion,
okay,
right? I then, as I started looking at this, right, like I'm seeing what Denny wrote here, this idea that these young people who don't want to settle down, right? Because they're saying some of the reason why this is happening is because younger folks, they have this like unplugged lifestyle new to old generations, right?
Sure.
And they don't want to settle down. But Denny, in the military, right, has been a career in the a not phenomenal career in the military.
Absolutely.
Says these young people who don't want to settle down can have their cake and eat it too. Rent their primary, own investment properties. The frustrating thing, they just don't know. They lack education by and large, and there's not enough shows like this talking about their options. That was my life, right?
Yeah.
Like Denny, I've lived it. And then Denny said, Eric and I do just that in the military. We move every 1 to 2 years at the most. Buying primary in places we don't want to own homes long-term is stupid. So we buy investment properties instead. Young people can do this with massive success as properly educated. I wasn't in the military, but I did this as well, right?
Yeah.
Like I knew that I was in Jacksonville, I was renting. I knew that I wasn't about to buy like the home that I really wanted to settle down in. So I started investing in rental properties. I had the benefit of the show and you and the community and all this type of stuff. Since young people don't tend to have that education, right? And maybe don't even have the means to do that right now in like what seems like a bloodbath job market for people coming out of college right now, right? With AI and all this stuff.
Right.
I think that not only is it a really, really good investment to invest in these assets for just about any American that wants to invest in critical infrastructure that has upside and high floor and whatever, I'm starting to think that if I had kids and I was a older Gen Xer, younger boomer, I would start thinking beyond this thing as an investment and more of this as like a family blueprint kind of thing, right? Like I'm not one for a handout, but I'm definitely one for a hand up. And the idea of investing in rental properties, whether it's like your kids going to college there, so buy a piece of property, have them manage it. You know, like I've seen folks do that. I know like when my grandfather passed away, we each, he gave us each 30 grand. And like my cousins, their mom's a realtor, bought them properties immediately with those things, right? So it's like doing whatever you can as a parent to get like your kid in the real estate game with part of your retirement, right? Like the thing that you were going to earmark for them anyways,
Mm-hmm.
right? Like
Yeah.
instead of waiting till you die to give it to them or whatever, right? Like starting to like get them, whether it is a house that they can live in at some point or an asset that they can leverage later on
Mm-hmm.
or something like that, feels to me like something that we will be talking much more and more about as this number continues to happen. What do you think about that?
It's interesting because I'm hearing, and I know you mentioned this a little bit before we got on air, but I think I'm understanding this at a deeper level now. So for you, if I'm understanding correctly, the average age for a home buyer right now is 56. I mean, if you think about that, our kids on average are not going to be able to buy their home until they're 56, right? So you've got that real challenge there, but it's more than just about the ability to make a good financial decision. It's about how can you give your kids the feeling that you had as a homeowner in their 20s or 30s, right? Why do our kids now? I mean, the real terrible thing about this is that our kids may potentially have to wait until they're 55, 60 years old to feel as a part of the community as you have felt, or as that we all feel.
I was 43.
Yeah, right. So what a gift you can give your kids beyond just the financial benefits of owning a piece of real estate. It's more of that gift of being a part of a community, being a part, feeling like you have planted your flag somewhere. Am I understanding that is?
Yeah. And just like the options of like I think the sooner that you get into real estate, the more chances are that you're going to be a homeowner, right? Like it is that gift of being part of the community, but it's also same thing I told you when I started investing in my stuff. I was like, I was sure that my ability to own real estate here was then going to allow me to buy the property where I actually wanted to live.
Yeah.
And it ended up playing out, right? Like it wasn't direct line, like, oh, I had to take my mortgage out from these other properties to go buy my dream home. But being part of the real estate game allowed me to understand the opportunity for when time came for me to buy my primary residence as well.
You would set yourself up for
So
that.
it's just like it's just injecting them with the real estate bug to a certain extent.
And for me, where my head goes after thinking about this is like, if, why do we have affordability challenges? Well, it's because the value of real estate goes up, right? The reason that we love this asset class is because it's so consistent. It's because it solves a critical need for everybody that I just mentioned there. And there's inherent value, and we all understand it. And as long as people want to have a roof over their head, we can feel confident that the value is there for real estate. So ultimately, affordability is here because people desire this. And you want to be investing in something that people desire. You want to help your kids invest in something that they desire. So there's that. Like, let's just think about why affordability is a challenge. Is because owning a home is valuable. It's a good thing to buy and to hold. But, there's the idea of helping our kids buy a home, right? And maybe buying it for them, which I think is amazing. Or if your kid's going to college and maybe buying the home they live in for 4 years because you got great renters, or maybe not so great renters right there. I love that. But I think the win here is if we understand that real estate is valuable and people comprehend it, and it tends to go up with inflation over time, and you really can create great financial outcomes for it. Like, the onus of teaching our kids how to do it for themselves at a younger age is even more and more important to me. That's where I would go. And having kids listen to shows like this, and having kids understand financial education like Denny is talking about here, and understanding and breaking down those paradigms, which have probably constricted many of us for many decades, and thinking about things differently, like a not your average investor, and looking at how you can work to your financial outcome by buying investment properties before you buy your primary. That might be the best thing for you, right? So exposing our kids to that level of education and relationships. And then I look right now, this is the best time for young people to have access to education and relationships. I had to work really, really hard to get education and relationships 20-something years ago when I first started down this journey. Now we see hundreds of people on the show right now that tune in every single week, and we get access to relationships and education and real friendships and people that are in your corner. So I think the onus of teaching our kids to do it for themselves with our guidance is even more important. And at the same time, it's a beautiful time for them to take a step. Tune into a show like this, listen to a podcast like this, start to listen, and so I actually think there's a great opportunity, even though affordability challenges are there. I think that our kids can really benefit now in ways that were a lot harder to do back in the day.
You say something often on this show, which is the money is the easiest hurdle to overcome. And that is very counterintuitive, right? But if you could grow up knowing that there is financial engineering and creative ways to overcome the money hurdle to achieve whatever you want in real estate and this type of thing, I feel like that by itself, right? Like that would be a super, super powerful thing to help a kid understand.
Yeah.
Like it's one thing to be like, look, this is what compounding interest can do. And then there's another thing that's just like, look how you can just manufacture wealth out of nothing.
Right.
Right.
Yeah.
Like that part of it is very, very real. Do you and your kids like sit down and talk about kind of like the dollars and cents of the real estate portfolio and stuff like that? Like how involved are they?
Oh, I wish.
Yeah.
A man can dream,
Yeah.
My kids are 13 and 11, and we've made it a real point that it's okay to talk about money.
Mm-hmm.
It's okay to talk about investments. They've sat right here and have done their own episode of the Not Your Average Investor Show, which is pretty fun. They listen from time to time, but my kids are 13 and 11 and I'm dad,
Yeah.
So like if the show comes on in the car or whatnot on the podcast, they're the quickest to change the channel. But what I know and what I have seen is I've heard them talk to others. And I've heard,
That's cool.
we saw my daughter Bella give her
Yeah.
talk at the last summit where she talked about
Yeah.
building a business and helping others. And remember when she talked about recognizing her 4 friends?
Dude, that was so
She understands the importance of culture. So to answer your question directly, the amount of times I get to sit down and actually review a pro forma with my kids is 0, but we talk openly about it. It's a part of every conversation. They are quick to be like, "Oh, come on, Dad. I've heard enough." They say it all the time, but I know it's sinking in.
That's cool. That's awesome, man.
Yeah.
All right. Greg Stone has a question here. He says, by the way, awesome shares here from the community, from Nadeem and from Ken, talking about their family experiences, and Denny and Michael, talking about like their family experiences of like buying real estate and how that's affected it. Really, really awesome. Greg Stone is asking, who would a foreign investor contact at JWB? He potentially has a friend in Germany, but he's not sure if his same contact at JWB is the same.
Oh yeah, just reach out to your portfolio manager, Greg. We've served clients that are overseas and investing here in Jacksonville with JWB, so certainly experienced in doing that. So hopefully we can help your friend out. So yeah, just reach out to your portfolio manager.
Cool. Now we're talking about something uniquely American.
All right.
See, it's football season.
Yeah,
as
it
we
is.
all know. I had my fantasy football draft last night.
Yeah, how'd you do?
I thought I did pretty good.
Yeah?
I did pretty good.
You don't want to brag too much.
The AR rating gave me an A, which is a kiss of death, right?
I got a C on mine.
So that probably means you're going to win your league.
Maybe.
So anyways, that's Fantasy Football Nerd Talk, different podcast. Professional sports teams, particularly NFL teams, have become this hallmark of thriving cities. They have been known for their economic development power, right? Like I think we talk about it all the time. This idea of like the UF campus come into Jacksonville is the biggest economic driver since the Jaguars showed up, right? Like it's a giant driver of economic power. Owning these franchises has become like the ultimate rich guy investing, right? Like, and these generally boil down to real estate deals that are public-private partnerships in some way. The strategy really matters and the results come after. What are you wanting to share here, GC?
Man, you know what? I love diving deep into these real estate stadium deals. As we dove a little bit deeper into the Jacksonville one, it started to just make me curious about other stadium deals. And so we put some research together. We'll get into it as much as you guys want to get all nerdy on the facts and whatnot. But at the end of the day, cities are doing whatever they can to not lose a franchise, like an NFL franchise or any professional sports franchise. They understand big picture that you gotta have them to be recognized as a major city. And if the Jacksonville Jaguars were to leave Jacksonville, for instance, we would never get another NFL franchise. And the quality of life in Jacksonville would be affected.
I mean, the Jaguars here are culture.
They are.
They are.
They are a big part of the culture. I couldn't tell if you were joking or not.
No, I'm being 100%.
They are.
I had to become a Jaguars fan in order to embrace the city. Like,
There you go.
No,
there you go.
It's about it, but yeah.
There you go. So cities realize that they got to do this, and then NFL owners realize that cities got to do this.
Yeah.
Right.
Yeah,
the NFL.
They're not dummies.
They're not dummies.
Yeah.
The NFL realizes that they got to do this.
Yeah.
Right. But what I think cities may or may not be able to take advantage of is how does a city do this stadium deal in a way where the financials and all the other uplifting factors get maximized by the city? Because there's examples of stadium deals that are done inside downtowns, and there's examples of stadium deals that are done outside of downtowns. And what we find is that the broad scale of the economics, when a stadium deal is done inside downtown, the economics are shared by the city. They're shared by the spillover effect of restaurants and hotels and those who own real estate in that area and those property values going up. So all of that noticeably has a bigger economic drive and return on investment when it's done inside a stadium, inside a downtown, excuse me. But when you go outside of the stadium, those city incentive dollars are still required to do those deals. But do you know who gets the majority of the return on that investment?
The franchise owner.
The franchise owner, because they largely own the stadium, or at least they profit, of course, from the team activities. Many times they build these other areas right around the stadium, but they own those, and there's not really a spillover effect from those event-centric stadiums into downtown or into other neighborhoods that you would otherwise get. So this is the big aha moment as we've been doing the research. It's, yes, cities are going to do whatever they can to make an NFL franchise or any other type of franchise stay. NFL knows that they're going to get these franchises and they're going to get the city to basically cough up hundreds of millions of dollars, sometimes billions of dollars to do it. But if the city can create a way where it's done inside a downtown, the city and the taxpayers stand to benefit a whole lot more than only the NFL owner.
Got it. So the picture that you are painting is essentially, NFL games are unique in that there's only 17 of them a year, right? So there's like 8 of them in, like that happen. It's a full day event. People will travel. Like I remember when they built Joe Robbie Stadium on the county line of Dade and Broward, it was precisely because they want people from West Palm, from Broward, from Miami, and even from like the west coast of Florida, all to be able to come in one spot because it's unique like that. That being said, just because people will travel just for one event doesn't mean that there isn't a better way to do it that creates an economic windfall, right? Like if you put these events in a place that spills over into the areas that can like absorb them and create economic impact for them, then it becomes more of like a catalyst flywheel effect for the city more than just an event-based circus that comes to town kind of thing.
That's right.
Do you have examples that we can talk about?
Oh, I got lots of examples. Yeah. So I did the research and there are a few examples of downtown centric projects. So we think of Washington, D.C. So Nationals Park, which I actually went to, that was done inside of D.C. We've got San Diego, we've got Petco Park, which I've also been to. Beautiful ballpark. And you walk through the Gaslamp District. Yeah. And you walk through and you walk into this beautiful ballpark down there. So that's inside downtown. And then Detroit, they built Little Caesars Arena, and that's largely inside downtown Detroit or a lot closer to downtown Detroit. Then you've got some examples of projects that, required a lot of incentive dollars, but are outside. So Atlanta Braves Stadium and Truist Park and the Battery, which I actually just went to a couple of months ago. Really awesome time, beautiful park, but not in downtown Atlanta. And then we've got, let's see here. Oh, Dallas and Arlington. I also went, man, you know what? I've been to pretty much all of these.
Tour, man.
This is pretty, I didn't even realize I've been to all these.
Your streak of family vacations to explore your real estate ideas continues.
You know what? I didn't even know that I was doing that for myself. Pretty much. Yeah, so Dallas and Arlington, if nobody's been to Jerry World out there, it's in Arlington, which is not in downtown Dallas. So you got a few examples there. And then there's recent stadium deals. So Buffalo, another one that I've been to, went to go see a Steeler game in Buffalo not too long ago. And it was interesting. I flew to Buffalo. I was going with a friend of mine. I was like, oh, where do I stay? I didn't really think about Buffalo being in Orchard Park. I'd never been there before. So I booked a hotel in downtown Buffalo. And I stayed in downtown Buffalo, and then we had to drive like 30 minutes to go to Orchard Park, which is where the stadium is. Well, there is now a new stadium that has already been greenlit, and they're building a stadium there.
They've been showing them on Hard Knocks, man. They're building it.
Oh, really? I haven't even been watching that. Yeah, they're building it now, and it's not in downtown. And then, of course, my favorite franchise to talk a little trash about, Cleveland. Guess where Cleveland is building their potential new stadium?
Not in downtown.
Not in downtown. They have a stadium that's downtown.
Yeah.
They're thinking about knocking that down and then building a stadium outside of downtown. So go figure. Cleveland's on the map here
Go
too.
ahead. Go push down at Cleveland. Go push down at Cleveland.
It's football season and we got 17 weeks. I can't just throw everything at them right now. I mean, I can't wait for them to lose a few games and then I'll really share my thoughts.
So bring us home, GC. So there's the city's doing it right, city's doing it wrong. Jacksonville, tell us how Jacksonville fits into this.
Yeah, so Jacksonville's stadium renovation is in the heart of downtown Jacksonville. And part of the reason that you're seeing so much economic activity around downtown Jacksonville is because there's $1.4 billion being invested in the stadium, which is in downtown. And big decision makers look at that and they say, oh my gosh, that's going to bring so many people there. That's going to uplift the neighborhoods right around downtown. That's going to spill over into our entertainment district. That's going to spill over into the Gateway Jacks project, which is another $2 billion development. That's going to spill over, and the spillover from the University of Florida is all going to be there as well, which is going to be a 10,000 student graduate campus when it's all built out. So the spillover effect is something that we're really excited about in downtown Jacksonville. And ultimately, these independent reports have been written about the fiscal outcome of these different stadiums. And in the different reports, they're talking about how, the taxpayers have bore the incentive dollars, but the net payout when those stadium deals are done outside are not really in the taxpayer's favor. And of course, the team owner shares the majority of the financials there. Yeah. And if you look at some of these same reports for, San Diego and Washington, D.C. and in Detroit, they look at it and the taxpayers are winning. The taxpayers are winning there. It's a noticeable difference. And they also talk about the catalytic development that is inspired in and around there. So like, if you're off in the middle of nowhere and you build this incredible Jerry world, it's hard for a developer to just tack onto that. It's much easier for you to put $1.4 billion into downtown Jacksonville and for small and big developers to say, you know what, I'm in the zone here. I'm going to take that risk of developing something, the next hotel, restaurant, whatnot. And so that's the real win. We understand these stadium deals have to happen, but cities have a way to maximize the return on investment and taxpayers have a way to maximize the return on investment when it's done just like we're doing here in Jacksonville.
You know what I think it's really interesting about Jacksonville, as you see, is that what you're painting right now is essentially the political will and the know-how to get this deal done in the right way, right? And you got to have that, right? Like being a Miami guy, like we are the kind of like the poster child for the Albatross Stadium deal that like screwed everybody.
Been there too.
Which is the Marlins Stadium, right? And at the end of the day, the team just kind of like bent us over their knee and had the political will in their favor. They had recently won a World Series and just got it done and whatever. One of the other challenges that was there was that there just wasn't space to build it in downtown, right? Like there was just a bunch of like issues, like it just created all these obstacles to even get into the political will argument because there wasn't the space, because it just wasn't there. Whereas in Jacksonville, not only do you have the political will, not only do we know the playbook, not only do we have an owner that's actually super committed to the city and he's not, like somebody that's just trying to get money out of
100%.
it, as he has shown over and over again, but there's also the space, right? Like this open canvas of downtown Jacksonville that allows projects like Gateway Jacks to come out of the ground and what's happening in the stadium, to me, I think can't be underestimated of like this, the luck of having this.
Yeah, I'm not the first person to realize this. Cities realize this too. And, if you can get more of an economic spillover into increased development in other places, like all cities would do this. Well, why don't most cities do this? It's a combination of those factors. I was in Arlington and I went on the tour of the Dallas Cowboys stadium and the lady who was giving the tour, she must have just, bless her heart, she was not expecting me to ask a bunch of these questions, but I'm asking, so how did Jerry put this deal together? What type of incentives were given? Why did they not use the incentives in downtown? She's like, sir, I don't really know. So I did a whole bunch of research. She helped me a little bit. The reason that, it wasn't done in Dallas was because they couldn't get the incentives approved. The political structure and the will was not there in Dallas to get the incentives that Jerry wanted to be able to do the deal in Dallas. So Jerry said, all right, I'm going to go to the next best place that's going to give me the number that I want. So it's a really special opportunity to do this. Now, they might not have land, right? They might not have the land to do it in that downtown because more downtowns are built out, and they just might not be able to do it. So it is a special opportunity to be able to do it in downtown Jacksonville. The fact that we have an owner who is committed to Jacksonville, who loves being here, and it doesn't just look at the franchise as the only way for him to run a profitable franchise. He's looking at building up the community around it. He's investing in a Four Seasons, which is right next to downtown. He's putting hundreds of millions of dollars into his own. So we have an owner who is a forward thinker and is committed to Jacksonville, which is unique. We have the land to do it here, which is unique. We have public-private partnerships coming together. We have our city leaders who believe that it's a good idea to give these incentive dollars because of what it's going to do for our taxpayers. And we have our citizens who voted, who say yes, by proxy. City council actually votes, but our city council members are listening to citizens, and citizens said, yes, we can do these incentives. That doesn't happen in every city, so we are really, really lucky, and we get to, I think, be a shining star of how to do a stadium deal where the taxpayers benefit and that economic development is catalyzed across all of downtown. We see those, we see it in rising property values. We see it in rising rents, but what we see it in, most importantly, rising incomes and more jobs,
income,
right? Rising incomes and more jobs. So I'm excited to share that story as it plays out, especially over the next few years.
I'm excited for that too. And I'm excited being on like the inner circle here of the Not Your Average Investor that knows that because this is happening in downtown means that these like surrounding areas, these single family workforce homes all around it, where you guys bring these offers to market, will all benefit from it. And it allows me to kind of like play alongside with billionaire Shad Khan as he redevelops downtown and benefit from it and take part in this like economic kind of like flywheel and all that stuff.
It's special, man.
That is the football edition of the Not Your Average Invest Show. Football kickoff edition of the Not Your Average Invest Show. GC. Not Your Average Insights, man. We haven't had it in a while. We had like 95 plus people here.
I love it.
At one point. I'm pretty sure we had over 100 folks.
We did. I saw it.
If we go overall, I love having this content format. Just like reacting to headlines, talking about what's going on.
I saw we had some incredible chat here as well. You guys sharing great stories. Especially I love when we talk about ways to help our kids or how to help young people take advantage of this. So, man, I love this. Great topics, buddy.
I do too. We got a couple questions here. I see one here from a Not Your Average guest. If you checked in with a text, I don't know what your name is unless you put it there. So they say, what about real estate taxes? They just seem to be going up every year, sometimes seem to outpace appreciation and monthly income. What is your expectations on taxes for the future of Florida?
Property taxes typically do not outpace home price appreciation. But what they do is they increase your expenses every single year. Home price appreciation is nice, but that equity just builds up and it doesn't typically hit your bank account unless you were to sell or refinance. So property taxes going up is painful for us as homeowners and investors because we feel it. So I get you there, but property taxes typically don't outpace home price appreciation. In fact, there's a cap on how much how much your property taxes can go up as far as your assessed values. And that's for both primary residences and investment properties. So typically it doesn't outpace home price appreciation, but I feel you there. We feel it on our expenses. At the end of the day, guys, if your property taxes are going up, that generally means that your home values went up a lot more. And when you invest in assets that can pay for themselves every single month, like we do, that are cash flow positive, including property taxes, then that's okay because, net, your rents probably went up, your taxes probably went up, you're still probably positively cash flowing, and long-term, your return on investment is growing. It's just, you got to look beyond that property tax number going up. So Hope that helps.
Andrew Barnhill, the ringmaster, also says property taxes can also go down and we pay about 1/3 what they pay in Texas.
That's a very good point. That is a very good point. Our property taxes are right in line with what is average for the U.S., which is unique for a state that doesn't have state income taxes.
Unique. Pedro Santoris, Michael Santoris says, Greg, don't you agree that housing affordability is driven at the local, Jacksonville, and state level by reducing or eliminating regulatory costs, allowing builders to increase housing supply, and offering tax incentives like Florida's proposed plan to eliminate property taxes for homeowners. I believe this will drive more migration to Florida, particularly Jacksonville, due to the low cost of living, affordable home prices, and high-paying jobs.
Let's just keep that up there because I want to make sure I answer those questions. Big picture, yes, absolutely. There are some of those things that we're talking about here that are already happening, and there's some of those things that I think may or may not happen. But at the end of the day, people are coming to Jacksonville because we're affordable. We are an affordable market already. Now, I think the real question is, as we have this growth happening, as we see what's happening in downtown Jacksonville, and we see median incomes going up and more people moving downtown and property values going up over time, how do we not become the next San Francisco, right? How do we make sure that we still are affordable? And the key to doing that is by doing a couple of different things. Raising median incomes, but just like Michael's talking about here, reducing regulatory and eliminating regulatory costs, increasing housing supply. Those are things that we need to be doing. You know, we are a part of that solution, but it needs to be a whole lot more than the 400 houses a year that JWB builds. So I'm hopeful and I'm happy that for the first really some of the first times that I can remember in my 20 years of investing, our local level, our state level, our federal level is starting to incentivize workforce housing supply. They're putting more dollars towards that. There's talks about reducing and eliminating some of the regulatory costs, doing it in a way that is responsible. So I think there's more of a desire to go in that direction that's been in the past. But Jacksonville, as it stands today, is in a good spot compared to our sister cities. However, my big question is, how do we, knowing that growth is going to happen here and we see home values going up here as a result of downtown and some other good initiatives, how do we stay affordable? That's going to be the next challenge for Jacksonville.
It helps that it's still the biggest bargain in Florida.
It is,
right?
Of any of the major cities.
I mean, I just like, to me, the cost of living to quality of life ratio here still continues to like astound me. From the weather to kind of like the pricing of things to the beach access to like where we are in Florida and the different road trips that you can have versus being all the way down the Panhandle and like having to drive 4 hours before anything changes.
I get it, man.
Quality of life here is phenomenal, man.
I'm not going anywhere.
I'm a big fan. I'm a big fan. All right, GC, next week we are talking about questions that you would need to ask a property manager in order to understand that they are the right type of team, right? We talk a lot about this idea of having the right order of operations, and we believe that most people have it wrong. They start with a property, end with the property manager. We believe you start with the property manager first. So we're going to talk about the questions that you want to ask to make sure that you're doing the right order of operations. Any last bits of advice before we get out of here for next week, GC?
Don't be average.